All right, excellent. Now that we know it is reasonable to expect there will be a relationship between the returns of stocks, we have to learn how to quantify this relationship. Let's zoom out and think of an example that is easy to understand and will help us grasp the nature of the relationship between two variables a little better. Which is one of the main factors that determine house prices? Their size, right? Typically, larger houses are more expensive, as people like having extra space. The table you see here shows us data about several houses. On the left side, we can see the size of each house, and on the right, we have the price at which it's been listed in a local newspaper. We can order these data points in an XY plot. The x-axis will show us a house's size, and the y-axis will provide information about its price. I am sure you notice a pattern. There is a clear relationship between these variables. Statisticians use the term correlation to measure such relationship. The final output of the calculation lies in the interval from -1 to 1. To understand the concept better, I would like to show you the formula that allows us to calculate the correlation between two variables. Here it is. Don't be scared, please. Let's apply it in practice for the example we saw earlier. X will be house size, and Y stands for house prices. So, we need to calculate the average house size and the average house price. That's straightforward, isn't it? I only have to sum the sizes of all houses and then divide by the number of houses we have. I'll do the same for house prices. Okay, excellent. This is the average house size and the average house price in our example. Now, let's calculate the nominator of the covariance function. Starting with the first house, I'll multiply the difference between its size and the average house size by the difference between the price of the same house and the average house price. Once we're ready, we have to perform this calculation for all houses we have in the table, and then sum the numbers we've obtained. Great! This gives us the nominator. It gives us a sense of the direction in which the two variables are moving. If they move in the same direction, the covariance will have a positive sign. If they move in opposite directions, the covariance will have a negative sign. And if their movements are independent, the covariance between the house size and its price will be equal to 0. There is one problem with covariance, though. It could be a number like 5 or 50, but it can be something like 0.0023456. Totally different values. How could one interpret such numbers? Proceed to the next lecture and find out why correlation helps us solve this issue and understand the two concepts a little better. Thanks for watching.